Hello all, welcome to Your Schemes. I'm Ilakya. I hope you're all doing well. This video is must for all working and earning youngsters and adults. This video is also for individuals whose retirement is at least 7 to 10 years away. Retirement is an inescapable truth of life. Everyone is going to retire one day or another. Many plan to live retirement life blissfully and comfortably. Most individuals wish to pursue a hobby, travel the world, meet friends, spend time with family and friends. But the truth is, regular flow of income would stop after retirement. But the expenses will continue. In fact, the medical expenses may rise with age. So everyone needs a good saving or investment which will provide financial freedom after retirement. One of the best investment option to plan retirement is mutual funds. You may say returns are not fixed or guaranteed in mutual funds as they are market linked. But let me tell you that well managed funds have the potential to generate good returns to build a decent retirement corpus. So today in this video we are going to see 4 types of mutual funds to help you build a good retirement corpus. This video is for information purpose only. Mutual funds are subject to market risk. Please consult your financial advisor before investing. Let's start with equity mutual funds. Equity mutual funds invest predominantly in equities, that is stocks. It may invest predominantly in large cap, mid cap or small cap stocks or across market caps. These funds have potential to generate inflation beating returns in long run. Who should invest in this fund? For those individuals whose retirement is at least 7 to 10 years away, they can invest in this scheme. Individual investing in this fund should afford to higher risk to earn higher interest. If you are planning to invest in equity funds, you can go for a mix of large cap fund, flexi cap fund, value funds, mid cap and small cap funds. Some of the good options under flexi cap fund is Quant Flexi Cap Fund, HDFC Flexi Cap Fund, JM Flexi Cap Fund. Under large cap fund, some of the best large cap fund include Nippon India Large Cap Fund, HDFC Top 100 Fund, ICICI Prudential Blue Chip Fund. Next for the mid cap fund, we have Quant Mid Cap Fund, Motilal Oswal Mid Cap Fund, SBI Magnum Mid Cap Fund. 3 best funds from small cap funds are Quant Small Cap Fund, Nippon India Small Cap Fund, HSBC Small Cap Fund. And best funds from value fund, Bandhan Sterling Value Fund, Templeton India Value Fund, JM Value Fund. Next on the list is debt mutual fund. These funds predominantly invest in fixed income generating instruments such as corporate bonds, government bonds and treasury bills. The aim of this fund is to provide diversification and stable returns. They are less volatile compared to equity mutual fund. These funds depend on interest rate movement. Who should invest in debt mutual fund? It is for those who want to protect their capital from market volatility. Investors whose retirement is still many years away can go for these funds. You can invest 40 to 50% in this category to get stable return with low risk. Some of the top performing debt mutual fund schemes are Banking and PSU Fund, Corporate Bond, Dynamic Bond, Gilt Fund and Liquid Fund. Best funds from Banking and PSU Fund, UTI Banking and PSU Debt Fund, ICICI Pru Banking and PSU Debt Fund, Kotak Banking and PSU Debt Fund. Under Corporate Bond, Nippon India Corporate Bond Fund, ICICI Prudential Corporate Bond Fund, Axis Corporate Debt Fund. Under Dynamic Bond, best of the funds are UTI Dynamic Bond Fund, Aditya Birla Sun Life Dynamic Bond Fund, HDFC Dynamic Debt Fund. Best funds from Gilt Fund include ICICI Prudential Constant Maturity Gilt Fund, SBI Magnum Constant Maturity Fund, Bandhan Government Securities Fund, Constant Maturity Plan. Under Liquid Fund, some of the best funds are Quant Liquid Plan, Mahindra Manulife Liquid Fund, Baroda BNB Paribas Liquid Fund. Next on the list is Hybrid Mutual Fund. These invest in 2 or more asset classes such as equity, debt and gold. It aims to maintain balance between growth and stability. also adding some safety by investing in bonds. Who should invest in hybrid mutual funds? These funds are suitable for investors looking to diversify across asset classes through a single fund. Those who want to follow aggressive investment approach can consider equity oriented hybrid funds such as aggressive hybrid funds, and those who follow a conservative strategy can opt for debt oriented hybrid funds such as conservative hybrid funds. Some of the top performing hybrid mutual fund schemes in the respective categories are: under aggressive hybrid fund, best 3-year return funds are Quant Absolute Fund, ICICI Prudential Equity and Debt Fund, Bank of India Mid and Small Cap Equity and Debt Fund. Under Conservative Hybrid Fund, Bank of India Conservative Hybrid Fund, SBI Conservative Hybrid Fund, Aditya Birla Sun Life Regular Saving Fund. And under Dynamic Asset Location, some of the top performing funds are Edelweiss Balanced Advantage Fund, Sundaram Balanced Advantage Fund, Invesco India Balanced Advantage Fund. Under multi-asset allocation, best performing funds are Quant Multi-Asset Fund, ICICI Prudential Multi-Asset Fund, Tata Multi-Asset Opportunities Fund. Next on the list is gold ETFs. A gold ETF is a passively managed mutual fund scheme that aims to track the domestic price of the physical gold by making the direct investments in gold. It offers investors an innovative and cost efficient way to invest in gold without having the hassle of physically holding it. If you purchase a gold ETF, units are allotted to you. The units purchased are backed by 0.995 fineness of physical gold. Thus, you can own gold without having to worry about the making charges, storage hassles, risk of misplacing or theft, concerns regarding purity. Gold has been performing better even when the equity fund have disappointed the investor. So during the inflation also, gold performs better. There is no default risk in gold investment and it is very liquid. If you want to invest in gold ETF, then you can consider allocating 10 to 15% of your corpus in gold ETFs. So these are top performing schemes under gold ETF. LIC Mutual Fund Gold ETF, Axis Gold ETF, Invesco India Gold ETF. You can start by investing a small amount regularly via SIP, and then when your salary increases, you can step up your SIP. Please understand the goal is to start investing early with smaller amount, and you should invest regularly and get bigger corpus. To conclude, if you have many years left for your retirement, you can follow an aggressive approach by investing predominantly in equity oriented mutual funds. If you are just a few years away from retirement, consider relatively safe asset classes such as debt funds and gold. To make your retirement days blissful, stop thinking and start investing. If you feel this information was helpful, then please hit the like button. It means a lot. For more similar videos, please subscribe to Your Schemes. Thank you. Have a good day. Bye-bye.